The greatest thing about the markets and what I've always loved about this business is it's different every day, right? There's always news, there's always developments. Now, these days it seems like those news and developments have a less of an influence on the daily trading action than they did the majority of my career. But I always viewed the situation as you're a detective and you're trying to put the pieces to the puzzle together and figure out, or it's a chess game where you're trying to see what the next move is. And then if what you do is a set of different scenario analysis of, okay, we have this problem going on in Greece right now. And, you know, for the past 6 months, I've been saying that Greece has been in a depression for 5 years, not a recession, a depression. They've had 25% unemployment for the past 2.5 to 3 years, right? That is a very bad situation. Europe continues to try to force this bailout upon them or extend this previous bailout that it wasn't a true bailout. It was one, you know, when we have bankruptcies and restructurings, we have bankruptcy laws in this country to allow people to get a fresh start, right? When Greece had its problems 5, 6 years ago, it was not given a restructuring to give it a fresh start. It was a restructuring that would allow European banks to not take losses, right? It's called extend and pretend. So if you pretend that you're still going to pay us the debt, we'll lower the interest rates, we'll lengthen the maturities, right? And we'll continue these bonds, this money we've lent you, these loans as good. The bottom line is Greece is in such a bad situation, 5 years of depression now, that the loans, of course, are no longer good. And the Greek government's been saying, well, you should be giving us a real restructuring. The first one wasn't a real restructuring that way. You know, we don't believe it was truly a valid bailout. And that's what this debate's been going on for the past 6 months. And I said, after 5 years of depression, 25% unemployment, in this country that wouldn't fly. You know, we would have tossed out our leaders. You know, people would be rioting in the streets. So it would just make sense for Greece to want to take a different path. So of course they elected the Syriza government in, and Prime Minister Tsipras and now former Finance Minister Varoufakis, they said, you know, in the past they'd be willing to leave the euro and take a different approach. Obviously this time they said they want to stay in the euro, but I actually truly believe they're just going through the motions, because I think they probably believe that staying within the euro, they have too weak an economy to sustain itself within a currency that strong. But I digress. So back to the point is that's how we wind up at this vote. And so when you have a situation with a new government coming in, they were anti-euro the last time they campaigned, and I think it was 2011. Well, what were the options? What can they do? Obviously, they can go and negotiate. They can accept the bailout that Europe's giving them. No, they don't want to do that. They can, push for a different bailout. Yes, they did do that. And then, will Europe give them that bailout? No, they won't. So they call for a referendum. Will the Greek people vote yes or no? And you're trying to figure out, of all these different scenarios, which ones are the most likely ones to play out? Which ones are the wild cards? And while it's hard to put actual, probability numbers on them now, but you could sit there and say, well, the Greek people voted down the referendum for the most recent bailout that Europe has offered. So that increases the likelihood of a Greek exit from the euro from what was probably, most people were probably saying was only, a 20% chance, a week or 2 weeks ago, maybe even lower, right, to now it's 60 to 80% now. And then you're trying to figure out, well, what different asset prices should react to that? Well, if Greek bonds obviously have been selling off, should be selling off. But then you have to think about the secondary effects, or where other peripheral European bonds, so Italy, Spain, and Portugal, they've had issues and problems. That, when the debt crisis first flared up in 2009, 2010, they had their own issues. So you see those bonds should be selling off. Then you add to the fact that these bonds have had a historic bull market run on the hopes of your ECB QE, which was foreshadowed for a year prior to it happening. It was launched in full force in March, and those bonds peaked. So these bonds have already put in some type of top. And now they should be selling off for the, the fear of contagion risk, because they're viewed to be economies that are at risk. They also have to now acknowledge if Europe takes losses on Greece finally, or Greece leaves, and the EU loses hundreds of billions of euros because Greece leaves the Eurozone, well, Italy, Spain and Portugal will have to take part of those losses. And again, they're not going to be happy that they're taking losses to bail out Greece when they've had to go through their own austerity measures and do their and follow their own programs to try to return to a healthy path. And then you would sit there and say, well, France and Germany, they're the two largest European economies, they're the strongest ones, so their bonds will get a flight to quality bid. So my whole point is you have this one news event that's going to set off different market reactions in different asset classes around the world. The dollar should strengthen, the euro should weaken, the yen should probably strengthen versus the euro, and obviously equity should sell off, and then obviously you're trying to figure out what's the best way to play it. Where's the opportunity, or I mean, what I find myself doing is warning clients that this is a risk this can happen, and if this scenario happens, look for this to happen. And you're trying to, like I said, you're trying to give these different sets of scenario analysis, and and hopefully you're right. Obviously, markets don't always do what you expect, but it's just so that you have a game plan. So when events start unfolding, you have an idea of what you want to do and what approach you want to take, and obviously what approach obviously everyone invests in financial markets. In many, most people invest in order to grow their assets, to make money. But one of the most important aspects is not losing money. Obviously, it's the return of capital instead of return on capital. And when you have an environment like we have now with very expensive bonds, expensive stocks, to me, I worry about the return of capital. That if you buy if you buy an asset at a bad price, no matter how good the asset, you're going to probably lose money, and people have to be aware of that.